Long-term history of equity markets, let's say 1850, 1860 to today in the US or in India for the last 100 years at least, for which we have decent data, which shows, or even if you take just the index from 1979 till today, that is about 43 years, market has only gone up, right? 100 was the index in 1979 and today it is 90,000 of the TRI, that is the total return index. So it has only gone up. Why has it gone up? There are two things. One is the power of compounding. See, when a company earns money, it does not give away all of it as dividend. So a company earning 100 rupees normally would give away 30 rupees as dividend and keep 60-70 rupees. What happens to that 60-70 rupees for a company which is well managed with a high with a high ROCE and high return on net worth? That is also compounding the value of the company, right? So you bought a share for 10 rupees and now it is 20 rupees. It is because of 2-3 things. One is the company is respectability is higher, people are willing to pay a higher PE, but also understand that the compounding which works for you in your equity also works for the company. The retained earnings compound, right? So there are two reasons why your money is doing well. One is the people's respect for that company is going up. Here is a company which is paying out 30% regularly and it has a policy of paying out 30%. So when it earns 100 rupees, it gives away 30 rupees, or when it earns 200 rupees, it gives away 60 rupees, right? So somebody who is consistently doing that gets a higher PE, and the fact that they have a policy because of which they are doing that is good, and the fact that their money which they have, they're building better distribution, they're building better products, they're entering more countries, whatever they're doing, they're using it very usefully, and you see the ROCE is high, RONW is high. You don't want these companies to give you dividend. What will you do with the dividend? You will again not know where to invest. So in the US there is something called a DRIP, where you can choose that the dividend does not come back to you in cash, but it comes back in terms of shares. In India there is no such thing, that the company will not do it but you could do it. So you get a good dividend in say a Coal India or an NTPC or in Vedanta. What you do is go and buy more of those same shares. Again, caveat, I have all this in my portfolio, but I may be selling next week. So you use that money and buy. So you create your own drip, right? So the power of compounding is because of the retained earnings and the dividends, and your growth is because the dividends which you got, you don't need it. The government of India wants dividend for whatever reason, so they make a huge payout. You get the money, you don't know what to do with it. Go and buy the same share. Go and buy NTPC. Go and buy BHEL. Go and buy Coal India, whatever, whichever company is paying dividend, or Indian Oil, or Vedanta, or Tata Power, or Tata Steel, whatever, any company which is giving, Coromandel International, any of these companies give you dividend, you don't know what to do, just put it back. That is again, power of compounding will work better. But remember, power of compounding of retained earnings is something which not many people talk about. Again, a Buffett quote, what has worked for Rockefeller and Carnegie has worked its magic for millions of shareholders as well. That is the power of compounding of the money retained in the business. I think we are ignoring that when we are doing the return calculation. So don't ignore that. That's very important. A company does not pay out high dividend is good for you, right? So let's say Zomato is making losses. Will the company be able to pay dividend? Answer is no, of course not. But tomorrow, once the business starts making profit and it does not have to invest in any more relationships, etc., that is going to come back to you as a dividend. Now, same thing for Apple or Microsoft or any of the companies, even Reliance for a long time was not a very big dividend paymaster, right? It was not a big paymaster. But now, once you start establishing your business and you have not much to do, or you have so much cash flow that you can fund your growth and you can pay dividends, you will start doing that. Like HDFC Limited used lot of its money to set up companies like HDFC AMC and HDFC Life Insurance, etc. So now it does not have any such capital requirement need, so it has a surplus. So if HDFC Limited were to continue, it would become a higher payout, right? But I'm very happy with companies which don't do a higher payout, because that money is being used for its growth. So whether it is an Indigo growing the number of planes or number of places it will reach, or a GMR infrastructure which will set up more airports, or any such company which is growing fast, which does not give dividend, is compounding that money. The companies which is giving you dividend and it doesn't know what else to do, go and buy the share or buy some other share. I mean, I'm not saying you should always use DRIP. Some company may be very boring, dull and not growing fast enough and therefore returning the money. Maybe you shouldn't be buying the share. You have enough of that share, right? So this is one more way of creating wealth, but it is not the only way of creating wealth. Largely human beings like certainty and symmetry. If I put money in the bank, I'll get 7% interest, I'll get 8% interest. This gives people the ability to sleep well. Unfortunately, the equity markets is about asymmetric returns. If you put 100 rupees, you can lose 100 rupees, but you could even earn 10,000 rupees. You will never earn that kind of money in a debt instrument, right? You took risk, you got extra rate of return, but you could never double your money or triple your money the way you can in equity markets. And that is what gives the people the attraction of the equity markets and the kick to be in equity markets, right? So I mean, basically asymmetric payoff is very attractive for people whenever they want to do something. If they put in X efforts and the results are 10x, it attracts more people than where you say X plus 10% or 7%. So asymmetric return is very important in equity market. So which means if you put 100, the maximum you can lose is 100, but you can get 10,000 out of that, become a 100 bagger, right? You can do all this. One thing I can tell you, in 43 years of investing, I still can't pick one single day which was the best day to invest, or on a day when I felt very confident that this is the best day, I should sell off everything and put. I've never had such a day, but I've constantly added to some shares and they have done well, right? So my average price of a share never remains constant because I'm constantly adding. What I subtract is a separate deal, what I sell is a separate deal, so that does not go to reduce the price of the share. So I may have bought let's say EID Parry at 16 rupees, which is a 10 rupee share. I must have also bought it at 110, I've also bought it at 300, I bought it at 200, and today maybe the price is 600 or 650, whatever. Bonus plates, everything. So it's not to say that by sitting and saying, oh, that day I should have invested, doesn't help. Sitting on the sidelines and bylines doesn't really help. You can be a bystander but not make any money, but you can keep writing about how great the market is, etc. That doesn't help. You have to get into the market to make money. It sounds very, very basic, but to make money in the market you have to invest. There are a few quotes which I should read out exactly what it is, so that it sinks in well. So the biggest thing about making money is time. You don't have to be particularly smart, but you just have to be patient. Who said this? Warren Buffett. Charlie says the desire to get rich fast is pretty dangerous. Again, quoting Buffett, he says people would rather be promised wrongly, of course, winning a lottery ticket next week rather than get rich slowly. Get rich slowly is something, I think there is a handle also by that name or a website by that name. It's very important to tell people that the power of compounding takes time to make itself visible to you. 3 years, 5 years, 7 years, you don't see it, but the 9th year, 10th year and 20th year, it just booms. Ask many MFDs, did they ever expect to create so much AUM? So if somebody has got a 1000 crore AUM MFD, he may have sold only 75, 80, 100 crores. But over 25 years, grown it from 100 crores to 1000 crores, largely contributed by market and referrals. That is how it has grown, right? So the fact is, get rich slowly is very boring, but it is the only thing which works. The advantages of dealing with equities is you can work from a remote location. You need not be situated in one particular place. You can do a lot of reading with the time that you have. You can work with the best management teams across the globe, right? Today you can work from you don't have a boss, you can be on your own, right? You can do, so these are some of the advantages. But what is required for that? First of all, a right attitude of saying, I will get rich slowly, I will not get rich overnight, I can't get rich overnight. I will need to do some perspective, some planning. I have to manage my emotions. I cannot panic, I cannot get carried away. I have to respect the power of compounding, and I need to exercise patience. Only when you do all these things in the right spirit can you create wealth in the market. And welcome to the markets. A lot more to go, but good start. Thank you.